U.S. consumers got more pessimistic about the economy last month. The University of Michigan Consumer Confidence Index fell more than economists expected as consumers faced a higher jobless rate and rising prices. Bank of America Merrill Lynch senior U.S. economist Michelle Meyer joins us now from her office here in New York. Michelle, welcome back to Bottom Line. Always a pleasure to have you on.
Always nice to be here, Mark.
Michelle, you say that consumer sentiment stuck between recession and recovery. Why?
Well, if you look at a long history, we only had a slight pop once we officially became into a recovery. But after that, it's kind of just bounced around in a choppy fashion and really hasn't broke out into a recovery sentiment that we've seen in prior cycles.
Michelle, what are the factors that are reflecting the weak consumer sentiment as we see it now?
I would point to three main factors that I think are still weighing on consumer sentiment. The first is the labor market. It's healing, but it's doing so very slowly. We've only gained back 1.8 million of the 8.8 million jobs that were lost during the recession, which means there's a lot of people who are still out of work, and they've been out of work for a long time. The second factor is the state of household balance sheets. The home is the biggest asset for a lot of people out there, and we're still losing value in the home in most of the nation. And I guess the third factor I'd point to is the availability of credit. We don't have, with tighter lending standards, we don't have the ability to kind of smooth through the decline in income and continue to spend by borrowing.
Michelle, is the specter of inflation also looming on the horizon for a lot of folks?
It appears to be. I think that was one of the most interesting things of the report, is that sentiment deteriorated, but yet inflation expectations over the long run actually ticked up. Now, this tends to be a noisy number, so we don't want to read too much into 1 month, but it's surprising given that gasoline prices have actually come down in the month. It suggests that consumers are more worried about higher inflation given that they had such high gasoline prices for a period of time, and also other types of visible prices like transportation costs in many cases are up.
And if the consumer, as you point out, is worried about this, what is this going to mean going forward? Because at first we saw the price of gas, it was rising, and then it came down a bit off of those highs. But are consumers still a little bit jittery about what to do with that discretionary income?
I think they are jittery, and the problem is there's not that much discretionary income. Income growth has been slow in this recovery, which means that consumers for a period of time had to allocate more of their income towards gasoline, and it's coming down, but gasoline prices are still elevated, which means consumers have to be, they have to tighten their belts a little bit more, and I think that's what we're seeing.
Is the outlook then at least a little bit better for the second half? Is there at least some silver lining in all of this?
I think there is. I mean, we have to remember that we're still growing. The economy is still expanding. It's just doing so at a slow pace. Some of this particular weakness that we're experiencing now has to do with production cuts, which are related to the Japan supplier delivery delays. So we'll see production swing back in the third quarter. Auto sales should also recover. But the fundamentals are still there. It's still a slow growth environment. It's still an environment where consumers are dealing with low-income growth, dealing with stressed household balance sheets, which means we should continue to grow. The recovery should persist, but it'll be a slow one.
Another break in gas prices, is that going to help temper some of this pain that we're seeing?
Of course, yeah, absolutely. If gasoline prices continue to come down, then that means consumers do have more income to spend elsewhere, and that will be a big plus. I also think if we start to see more confidence in the overall economy, more credit creation, that's key. The ability for credit to move through the economy, that's the oil for the engine of the economy. And so far it's been only slow.
And the consumer, they're still concerned about the labor market, still about that jobs picture with the unemployment rate at 9.1%. We saw another report today from the Labor Department showing that payrolls in 27 states dropped in May. What's the significance of this?
It means it's widespread. You can't just argue and say that it's a few regions within the U.S. that have particular weakness, those that have high construction economies or those that are in the Rust Belt. It is more widespread than that. And I think the data is reminding us that, yes, there's pockets of strength in certain regions, but overall, most Americans out there, as we saw in today's consumer sentiment report, still feel like it's a recessionary environment.
Michelle, could I ask you again, because you mentioned just briefly a moment ago about those supply chains disruptions in Japan because of that earthquake and tsunami back in March. When does that start to settle itself out?
think there's a lot of uncertainty around that. We've been told that a lot of the Japanese automakers are coming back online now. So perhaps by the end of the month, early next month, they'll be back, or at least close to full capacity. But then there's lags. Their production has to be shipped over to the U.S. Those parts then need to be included again for us to make our final goods and then ship them through. So I would say there's still another 2 months or so before we really start to see a return to a normal environment absent the production issues.
Michelle Meyer, she's the senior economist at Bank of America Merrill Lynch, joining us from her office here in New York. Michelle, it's always a pleasure. Have a good weekend.
You as well.
Thanks.